Today the market looks scary, red everywhere, confidence shaken. But the thing is, dips like this do happen, and often, they're necessary resets before the next leg up. In this video, we'll break down what's really driving this dip, why it's not the end, and what you can do right now to stay in the game. This is the Wealthy Wallet. Let's dive in. One of the big recent catalysts, a surprise announcement of 100% tariffs on Chinese tech imports, which rattled global markets and brought risk assets to the edge. That kind of geopolitical shock doesn't spare crypto. When macro risk rises, investors pull capital from speculative assets, crypto especially, and that can cascade into selling, even if fundamentals don't change. In one of the worst days ever, over $19 billion in leveraged crypto positions got liquidated. That means many traders using leverage were forced out automatically, which amplifies declines even in coins you thought were safe. Leverage is like gasoline in a fire. When markets wobble, it doesn't take much to tip the balance. We're living in a world where interest rate decisions, inflation data, and central bank commentary carry massive weight. The slightest hawkish hint or upside inflation surprise can spook markets. Add in global supply chain stress, trade tensions, dollar strength. These all pressure risk assets. Even sentiment indicators are flashing fear. The market's fear index in crypto has dropped, showing growing risk aversion. Despite the volatility, record inflows into crypto ETFs are happening. That shows institutional capital isn't retreating, it's just pausing. These flows create a base of demand that smaller retail sentiment can't wipe out. Weak dollar, inflation hedging, deglobalization. These are macro themes that favor decentralized assets when confidence in traditional markets wobbles. Also, regulation is catching up in many places. Once clearer guardrails exist, capital can flow with more conviction. Think L2 scaling, ZK proofs, composability, DeFi, and RWA expansion. These are not undone by one day of chaos. Many projects are shipping major upgrades and partnerships in 2025, which set up upside once sentiment returns. All bull markets have corrections. A dip forces weak hands out, resets valuation, and clears the way for institutional returns. If the last few cycles teach us anything, the deeper the shake, sometimes the stronger the recovery. Personal rule: only sell a portion if a key support breaks. Don't liquidate everything, let the rest ride. The math of compounding an upside is too powerful to abandon in fear. Add selectively on strength, charge, weakness. Watch for bounce zones, consolidation zones, and strong support levels. Consider dollar cost averaging deeper into quality projects. Diversify across sectors, so one vertical collapse doesn't wipe you out. If you're using leverage, consider cutting exposure or using options to hedge. Avoid over-leverage in this environment. This dip is a reminder leverage is a double-edged sword. Track macro and sentiment signals closely. Fed announcements, PMI data, CPI prints, tariffs, and trade news. Sentiment indicators, volume flows, ETF flow data. Use these as early warning or confirmation signals. This is not day trading. This is building wealth. Ask, where will this market be in 2 to 3 months? If fundamentals hold, this dip is part of the story, not the end. Dips like this feel brutal. and they are. But when you zoom out, markets are not derailed, just reset. Institutional capital is waiting, fundamentals are still advancing, and momentum cycles do return. The question is, will you let fear chase you out? Or stay focused and ride it through? If you found value in this breakdown, hit like, subscribe, and drop a comment. What macro signal are you watching next? This has been The Wealthy Wallet. Keep your conviction, stay informed, and let time work in your favor.